Okay, so hello, anyone watching this, just for the record. I'm recording this on Sunday, March the 17th, about 2 p.m. in the afternoon. So we're a few days before the FOMC meeting, which is coming up this Wednesday. So the point of this video is to try and look at a little bit of context just around what's going to be happening at the FOMC decision, as I say, coming up in a few days. And of course, we all know that the markets could actually price in a few things or do a few different things over the next 2 or 3 days. So keep in mind, as I said, I'm recording this on the Sunday before the Wednesday. Okay, so let's just take a little bit of sort of a step backwards. What I want to do is just to, as I say, provide a little bit of context. So I'm going to use as a base case, well, a base instrument here, the 2-year yield, because that's the one which is being affected quite a lot by the Fed. And this is a daily chart. So very simply, I know a lot of you will know this, but excuse me, very simply, we can see that when the Fed sort of not the second last meeting, when we got the last summary of economic projections back on December the 13th, 2023, you can see that the yields went down substantially. You can see here that the yields went down a lot. And since then, we've essentially done a round turn, and we've now come all the way back to basically where we were with the Fed. So it's kind of interesting that what we've actually done in the last 2 or 3 months is to go right back to where the Fed was. So there was peak dovishness. So the key dates here are December the 13th. Then we had peak dovishness around about January the 12th. And ever since then, we've been going all the way back to December. So why is that? Why did we have this drop, and why have we had this sort of round trip? Well, firstly, we've had this drop just because the Fed, at the summary of economic projections, and basically the drop here on the 2-year yield, this is like 61 basis points. And if we go up from here back to where we were, it's also 61. So almost exactly, down 61 basis points, up 61 basis points. And as I said, why is that? Just because the Fed, at the summary of economic projections back in December, they led the market to believe that a cutting cycle was, within range, that they were very happy with the data. They were very happy with the progress on inflation. And they basically said they increased the number of cuts, which they had penciled in on the famous dot plot. So the market took that as an opportunity for the yields to go down, the bonds in general to rally, the curve to sort of a bull steepen, equities up, gold up, a general sort of rally. Now, why has this gone down? Very simply is that since we've had that, obviously we've had higher than expected CPI prints, we've had higher than expected PPI prints. We've had higher than expected core PCE. And of course, the economic data, especially in the form of the labor market, has been pretty strong. We have seen some surveys numbers which are a little bit soft, but the basic idea is that even if the survey numbers have been a bit soft, the hard data has continued to basically say that inflation has come down. It is coming down, but it seems to be sort of stuck now. It seems to be a little sticky. And the problem is that the last 1 or 2 prints are even showing evidence of a little bit of an uptick. Not disastrously so, but it seems like the easy work, so to speak, has been done. And the labor market continues to be very, very robust. Spending continues to be robust. And so now what the market is basically saying is like, okay, Fed, what are you going to do this Wednesday? So we can look at just a couple of things. I just want to put this all in context with a few different numbers and just have a look at all of this, just to have a little sort of a level of detail here. So what we can see, again, just as it's interesting to put a context here, this is how the market was trading the day before the December Fed meeting. So the day before they changed the summary of economic projections. So that's the 13th of December. And you can see here that at that point, so just at the meeting, and you can see then that basically the market was pricing in about 146 basis points of cuts, which is almost about 6 cuts by the end of this year, 2024. So that's almost 6 cuts. And then if we actually look at sort of peak dovishness, when the market was sort of cheering, we can see that number, if we go up to the 12th here, if we go up to the 12th of January, actually that number went up to 6.5 cuts, which is almost 170 basis points of cuts. So it was that point, January the 12th, where the market was cheering, the Fed's going to cut very, very aggressively. Everyone was very, very happy. But now if you look at this, so again, just keep that in mind, 170 basis points, 168 basis points of cuts by this December, or another way of looking at that is 6.7 cuts. And this is a snapshot I did just after the end of market on Friday. And you can see, look at that, radically different now. The market is now only pricing, not even 3 cuts, about 2.8 cuts just here on the Fed funds futures, or only about 72 basis points of cuts. So essentially, we're now down at about 3 cuts, and you compare that to peak hawkishness of 6.7. So the first thing to note is that the market has been looking at the data, and the market has indeed repriced in a very kind of hawkish way. And we can see that if we just look at the curve of, let's say, the Fed funds futures. So I'm just going to bring that up. I think it's here. Yes, so I've got a lot of stuff on my computer here, guys. Yeah, so let's have a look at that. And where is that one? I think it's this one here. So this is the curve. So this is where we are today. And you can see that this is basically the yield. So we can see here that the yield is expected, to sort of start falling. So the market is still sort of pricing in cuts. But what's kind of interesting, if we put like a sort of a custom date here, and let's put that 12th of January date in, which I'll do right now. We'll do the 12th of January. So again, this is peak dovishness. And we'll just let that load up, and I will zoom in a little bit just to make it a little bit easier. You can see just how incredibly radical this change has been. So as I say, this is where we are now, and this is the implied yield from basically a couple of months ago. And you can see that all across the curve, but especially in the 2024, you see down below here all those tenors or all those contract expiries on the Fed funds futures. They've all been repriced almost up to 80, 90 basis points, anywhere between 50 and sort of 80, 90, sort of 100 basis points here, very, very aggressively up. So the market is still expecting Fed cuts, but obviously not nearly as much. So really what we need to know now, and this is an election year, of course, and just one thing to keep in mind, I'm just going to put that on the side and kind of park it on the side, is that historically the Fed does not like to be seen to be interfering in the political process. And so some commentators and some economists are saying, well, it's doubtful that the Fed, around about the September, October, November, when we have the US presidential elections, will actually sort of cut, because that will seem to be sort of, being political. So therefore, we're at this pretty crucial situation now where the market is saying, what is the market saying? The market is basically saying, okay, the Fed, is not cutting in March, this Wednesday, obviously. May seems to be off the table. And what's kind of interesting now, if we look at what's priced in for the June meeting, the market had been pricing it in, and I think I put it up here. Let's just check. Yeah, this is June. So what's kind of interesting here, this is a daily chart to see how the market's changed. And again, if we go to that sort of middle of January kind of period here, we see that at that point, what had been priced in January for the Fed June meeting was over 80 basis points. So, about 3.5 cuts. And as you guys know, and as you can see here, confirmed, we're all the way down to 15. And if we actually just put that on a slightly, we'll zoom it in a little bit. Let's say, for example, the last, I don't know, let's say 30 days on a 10-minute chart. Let's see if this loads up. You can just see the progress there. So, when we're getting sort of data and CPI readings, you can see it just keeps on being pushed up and up and up and up. And what that's saying here is that less and less basis points of cuts. So we were at 45 basis points. Where's that? Basically beginning of February. And here we are today, as I say, March the 17th at about 15 basis points. So at this point, about just over, let's call it about a 60% chance of the first cut still happening. So the market is not discounting a Fed cut at this point. And let's now look at just a couple of other things. So I'm just going to go back here and see what else I can show you. Sorry, guys, we just got a lot of stuff here. Sorry, wrong one. So what I'm going to do here is just to go and look at the dot plot and see what all the fuss is about. Okay, so obviously what we're going to have an update of the summary of economic projections this coming Wednesday in about 3 days or so. Now, the first thing to be looking out for, of course, is going to be for the change in real GDP for 2024 and probably 2025, but let's especially concentrate on the 2024. As you guys can see, the last time around they pushed that downwards. The projection went downwards. We've been getting fairly strong GDP. So the question is, will that be revised up or down? That's definitely got to indicate what the Fed is thinking about the general economy. The unemployment rate maybe is going to be pushed up to 4.2. It's going to be interesting here, of course, to look at their forecast for the, actually, forget the headline, the core PCE. Will they keep those steady, or will they revise it upwards? That would be hawkish. Or will they just keep it steady? But really where, everyone is looking, this is going to be very, very important, is at the Fed funds rate. And this is essentially the Fed sort of trying to give a bit of a hint to the markets of what they're going to do. The markets will move on this. So let's look at these numbers. So first of all, if we just look at these dots, we'll look at it in graphic form. You see here that this is the number we just looked at, but sort of in graphic form. So this is where all the various anonymous Fed members think the Fed funds futures will be, the median at the end of 24, 25, and then the longer run. Now let's think about this longer run. The longer run has been at 2.5, and as you can see here, the majority here at 2.5 for a long time. The longer run you have to think of as what they call the neutral rate, or otherwise you can call it R star. Neutral rate is the idea where the Fed thinks the monetary policy is neither accommodative nor restrictive. The idea is that if they were to change this, this would probably unleash, this would cause a lot of volatility. If they change this to the upside, this would cause a lot of volatility. I will get to that in a second. But what I want you guys to notice is that of the FOMC members, there's normally about 17 or so. I was reading somewhere, I forgot the exact number, but I think it only will take 2 or 3 members to change, and these medians could change. And the ones which are really going to be most interested in is probably 24 and 25, and then the longer run. So let's actually just go back to the numbers themselves. It's kind of simpler. So what it was telling us before, if we go back to the December one, was that the Fed essentially said that they were going to cut twice in 2024. So you can see here, where it's right from 5.1 to 4.6. So that's 50 basis points. So 2 cuts. Sorry, no, let me rephrase that. It was actually 3 cuts. Okay, so basically you can see here that was going from 5.4 down to 4.6. So that's that's 3 cuts. 3, very, very important. 3 cuts were priced in, and then going from 4.6 down to 3.6 is a further 4 cuts. So the bottom line is that back in December, the Fed was saying 3 cuts this year, and then 4 cuts for a total of 175 basis points over the next couple of years. And basically what they're saying is that the longer run, which is the neutral or R star, should be kept at 2.5%. What we have to do when we look on Wednesday at 2 p.m., and we'll get the updated one, is whether they change the 4.6, does that remain at 4.6 or does that go up? Or also what happens with the 3.6 and what happens with the longer run, okay? Now, the longer run is of extreme importance because if they were to revise it upwards, which they haven't done for many, many, many years, that would be a tacit admittance that the Fed, in a certain sense, is uncertain about where the neutral rate is, where they want to get to. Also, not only that, uncertainty about whether maybe it needs to be revised upwards. Now, if it needs to be revised upwards, that's more or less signaling to the market that they think inflation is going to be a longer-term cause for concern, that their inflation target maybe cannot be met, that the neutral rate actually needs to be revised upwards. That would put a huge amount of volatility into the markets. And that would put a huge amount of pressure on all asset classes. So let's just now have a look. What I want to do now, guys, is just to have a look at a couple of things here and share with you the SOFR watch tool. Now, the SOFR, I think it's here. Now, the SOFRs, of course, are the short-term interest rates. The short-term interest rate futures. So this is what we have now. So this is what is being priced in literally now as of end of market on Friday. So you can see here that what the market is pricing in currently is very closely aligned to the Fed. You can see here at the top here for the meetings, minus 25 basis points, minus 25 in September, minus 25. So basically this is fairly aligned with the dot plot. And what you can see down below here, these are the various SOFR contracts. You can see the current is kind of the red line, and the blue line is the predicted, and you can see that they're more or less on top of each other. And so at this point, basically what the Fed is saying with the dot plot and what the market has moved to hawkishly reprice, as we've seen since January the 12th, it's in alignment. It's in alignment, okay? And what you can also see is that if we go out into 2025, this doesn't go all the way out to December, but that's also pricing in essentially what the Fed is saying of about 4 cuts, because we don't have the December one, okay? You see 1 cut, 1 cut, 1 cut. So we've got 3 for 2024 and then basically 4 going out here. But what I want you to notice here is if the Fed for the dot plot actually takes out a dot and they go from 4.6 to 4.9. So they revise the expected place where the median will be at the end of 2024 from 4.6, and they take it up 25 basis points. What are they doing? They are effectively removing a cut. So that's what I'm going to do now. I'm going to remove a cut. So even if they cut, let's say in June, I will take out, let's say this one here in September. Why September? Because as I said earlier, we can assume, I mean, we can't guarantee it, but we can assume from our historical evidence that the Fed around election, and remember the elections is on the first Tuesday in November, we can assume that the Fed will not want to interfere or be seen to be interfering with the Fed. So it'd be very unlikely that, let's say on the 7th of November, that they would cut. Okay. And let's say, so now we've removed one cut. I'm going to calculate. And I want you guys to look here at what happens down here. Okay. So this is the new scenario. If the Fed this Wednesday probably revise, if they revise their median dot from 4.6 end of 24 up to 4.9. And what you can see is that a lot of the pain is going to be at the front end of the curve. And you can see here suddenly that the price, this is the price now, see, of the predicted is going down a lot. And we can see that most of the pain to the tune of about 21 basis points will be in the September 2024 contract. That will go up in yield about 21 basis points. You can see in the December, a full 24.6, so that's really the full thing. And then also, basically March 2025, there will also be a full cut taken out. So we've got about 20 to 25 basis points, which will come down in price. So that's about 50 ticks on the SOFR contract, or about if we look on the ZT, 25 basis points, it's about 4 ticks per basis point. So that's going to be, what's that? That's probably about 100 ticks or so. Okay, so about 4.2 ticks per basis point. If we have a 20 basis point change, you're looking at 80, 90, 100 ticks in the ZT or the 2-year contract. So very significant. But what's also interesting and a little bit scary as well, let's say, for example, for the 2025 dots, they're even more hawkish and take out a further one. Let's say, for example, we remove, I don't know, let's say we remove the June one. You can see here, I mean, I don't know if it's going to turn up. Well, we don't really see it too much, but that would also be extremely hawkish. Okay. So the point I'm trying to make here is that these dots are extremely important. And again, let's just go back and look at where you're going to see these on the summary of economic projections. So just keep in mind here that 4.6. Now I'm saying if they take out one cut, that would go to 4.9. Now what they could do is there's all kinds of scenarios. So we've got 4.6 currently, and then minus 100 basis points is 3.6, and then the unchanged, the longer run 2.5. So let's look at sort of a couple of scenarios. And I found a nice little document, which I broadly agree with here, which is, where is that? I think it's this one here. So this is kind of a nice document, which we've got a bunch of scenarios here. And I think, guys, this is really worth doing a screenshot on and having a look. So here, what's going on here? So basically what we have here are the dots. We have the initial move, by which I mean probably in the first, half hour or two. Then the next day or two, which is a bit vague. And basically, I agree with this because I've analyzed this, and I think this is pretty good. And let's go through this. Okay, so what would be, this is max hawkish, and this is unchanged. So what would be dovish would be if they change nothing. Basically, the Fed says, yep, Powell at the press conference says, yes, we understand that the CPI and the PPI has been a little hotter, not quite as good as we'd wanted. We understand that the labor market is still strong, et cetera, et cetera, et cetera. But we're okay. We believe that things are tracking in the right direction. I do believe that if everything remains unchanged, that would be a buy almost all across the board. So we will probably see assets going up. Let's say, most asset classes would be going up. The bonds would be a buy. The stocks would be a buy. Now, what about the next day or two? It's interesting we say sell the bonds. When I say bonds, I'm talking really about the long-term bonds. So you're talking, at least from, let's say, the 10-year and the 30-year, something like that. Now, why could possibly they be under a bit of pressure? Because what would happen here is that if the Fed is seen to change nothing and not to really react, the bond market initially would rally. And again, bond market, I mean the long-term bonds, but probably the bond market, and that would be a bull steepener. So essentially that means the front end of the bonds the yields would go down. But that means that the Fed would be less aggressive combating inflation if they do nothing or don't, or signal that they're not going to do much. So eventually, maybe the longer term bonds may not like that. And don't forget that we still have incredible amount of issuance because of the deficits by the current White House. And, also if Trump wins, he's probably going to have a lot of deficit spending. So there's still going to be structural pressure on the long end of the curve. Now, let's have a look at, let's say, for example, the only change is in 2024. They just revised that. And essentially what they're saying is, hey, guys, we're still going to give you the market 2 cuts, but maybe the third one will push it out to 2025. So technically at that point, rather than saying a total of 7 cuts, they'd be saying, okay, guys, we're still going to give you cuts. Don't worry, we'll give you plenty of cuts in 2025. And the longer run would be unchanged. I do believe that would be relatively neutral. That is, I would say, one could argue that's almost priced at this point, because as we saw in the last week, we've seen a pretty aggressive sell-off in the front of the curve. And again, if you look back over a longer time frame since January the 12th, we've seen a very aggressive sell-off in the 2-year yields of 61 basis points. And I've got all my little notes here. And if you look back at the SOFR contract from of December, basically in the last couple of months, that's sold off 100 basis points. So it's not like the market has been doing nothing. Now, again, if in that scenario, possibly after a day or two, gradually you would start seeing the yields on the long end go up, or the bonds being sold off. Now, what happens if we start to get into the more hawkish scenario that, let's say, for example, if for 2024 end of dot, they actually took off a cut. And then let's say for 2025, it went up from 3.6 to 3.9. So suddenly they're taking off a cut out of the 2024 and they're reducing a cut in 2025. That starts to be a significantly hawkish scenario. You're talking that, most assets would sell, the bonds would sell, the stocks would sell. We would most probably get, in terms of the curve, that would be a front end led bear flatten at the front end of the curve would not like that. And as we saw looking at the SOFR tool from the CME, especially September, December 2024, the March contract of 2025 would probably sell off in that scenario, anything from 20, 25 to 50 basis points or so. Okay, now what's interesting is that would indicate that the Fed was a little bit concerned about inflation, but they were kind of taking actions to be a little bit more hawkish and have less cuts. And therefore, sort of in the medium term, the long-term bonds might, even not necessarily like it, but they would find that less of a problem. And of course, at this point, you'd start to see the stocks probably selling off a little harder. Now, what is the maximum hawkish one? And this, I think, to be honest, is pretty low probability. This would be I almost was about to use the word, a massive shock to the market. This would be an extremely hawkish scenario. But as traders, we have to consider this kind of thing. And what would be extremely hawkish would be if they removed a cut from 24, they removed a cut from 25, and they actually revised upwards the neutral rate, which is what they call the longer run. So remember, it's been at 2.5 for many, many, many years. If they revise that upwards, as I said earlier in the video, they would be signaling was that R star, or the neutral rate, needed to go higher. And it's also signaling in a certain sense that they've lost control or they don't know. Why do I say that? Consider the following situation, or the following reality. Remember that the CPI was almost in double digits back in 2000, let's say 22, 23, when inflation was at its peak. During that period, the Fed did not see the need to revise upwards the longer run rate. Okay, they did not revise it upwards. So why would they do that now? So you see, the point is that would be quite a radical move, and essentially saying, hey guys, and maybe even that would be seen by the market as a precursor that the 2% average inflation target, maybe the Fed is trying slowly to tell us that maybe it's going to be 2.5% or 3%. And that's a sneaky way of doing it. But the point I'm trying to say here, guys, is that if they were to do that, that would be extremely aggressive. That would unleash a lot of volatility. That would be, I've written it here, an aggressive sell all across the board. Having said that, for the long-term bonds, they'd go, oh my God, the Fed's going crazy and hawkish. I mean, technically, that means they're attacking, the doctor's giving a lot of medicine to the feverish patients. So that would be seen as, medium term less nasty from the long-term bonds, because the pain would be very aggressively taken by the stocks and the front end of the curve. So that's kind of interesting to be looking at that. I think this is a pretty good scenario. This is the way one should react to that. And I just want to talk a little bit as well, guys, just about a few other things. Let's go back to a few charts here. So just in terms of volatility, something which I think is worthwhile looking at. Let's see, I think this is what I want to be showing you. I just want to show you guys the move index. Now, the move index, by the way, I think, if we were to see that sort of the Fed signal that the longer term rate needed to go up, I think we see that the VIX has been slowly grinding upwards. We'd see a massive spike up in the VIX, probably getting up to these 22 levels, which we haven't seen for 3 or 4 months. I think that would be you could if you could get onto that, it'd be a very fast move. But buying sort of calls or call spreads on VXX or something like that would be pretty interesting there, or selling puts on the VXX short term would be interesting. So we see that. But the one I want to look at here is the move index, which I think most of you guys know is similar to the VIX in the sense that it's a volatility indicator. And what is interesting here is that you can see that this is what the market is saying. The market on bonds, this is the volatility of bonds. And what you can see here is that we're now at a pretty interesting level, which corresponds to these levels going back to the beginning of January 23 and kind of September of 23. And what I want you guys to notice is that these levels, which is about 97.8, we've been grinding down towards them. So what is that saying? That's saying less and less volatility in the bond market. And what is that saying? That's saying that the bond market overall sort of thinks that they understand what the Fed is doing. They understand the Fed's communication policy. They believe that bonds and bond yields should be trading more or less in a range, and they're relatively comfortable with the forward path. Now, but what is interesting, though, at around about these levels in the last 2 occasions, if you actually go back on the individual tenors charts, like on the yields, you can see that this was the beginning of a pretty aggressive spike upwards in the yields. And generally what you see in that in terms of volatility, which is kind of interesting, is that if the volatility is low in the bond market, a lot of portfolios which are balanced, let's say 60-40 portfolios, that kind of thing, it's like what one commentator called the base of the pyramid is stable. If the base of the pyramid is stable and you have low volatility in the bond markets, you can kind of factor in your returns. And then you can maybe take a little bit more aggressive risk in, let's say, like equities, crypto, other sort of riskier assets. But what is interesting is that as soon as, if you go back and look at the charts, when this move index started to spike higher, we started getting more volatility overall in the bond market. That had a pretty aggressive and immediate effect on other risk assets, specifically sort of equities, for example, especially the high beta kind of equities and like, some of your tech stocks and whatnot. So quite interesting to see, to keep your eye on this level. As I say, it's on the other hand, if the market likes what they hear from the Fed and this move index stays around about this 97.8 level, or even kind of gaps below, not gaps, but let's say grinds down below, you see here, it's like we're at a quadruple bottom here. Like this is a big level, guys. Now, if this actually can break down to the downside, that would be considered a risk on kind of situation. Low volatility in the bonds, asset managers love that. Let's start loading up more on riskier assets. That would be a tremendous tailwind for risk assets, probably for crypto as well, your riskier stocks, your NASDAQs, all of the tech stocks. So just keep an eye on that. That's going to be a pretty good indicator. I mean, just another thing which I just want to show you guys, which I forgot to show you, but I think kind of quite interesting here, is actually just to look at the probabilities. So if you go back to sort of this and what I was showing you here, these are the various scenarios. But the question is, what is the market expecting? So I came across a pretty good sort of graphic. Now, the way this graphic works is to look at the Fed funds future. So it's like the SOFR for December 24, which is kind of what the market is saying, like, hey, what will the Fed do in 2024? And what's interesting is that when you look at the Bloomberg what's priced in on the WIRP function, we can, people like to say things like, oh, at the moment, I mean, actually, I'll show you guys. So let me just go back. I hope I'm not wearing out my patience here, your patience here. So if we go back and look sort of live just on the Bloomberg, we can say, oh, at this point, the market is saying that for, what's going to be priced in. But this is sort of an average. This is an average. All of these numbers here are average. So you can see they're saying for the December, they're saying, oh, about 72 basis points of cuts is the average, and an implied rate of 4.60. 4.60. But what's interesting is that if you actually look at the options on short-term bonds, and that's what this pricing is here. So what we've done here, or what we have here, is to look at the different scenarios and what the percentage is. You see, so on the Bloomberg, it kind of gives you a median of this, and it comes up with a number and says, oh, this is what's priced in. But what's useful here is to say, well, okay, and we can look at actually the numbers rather than the graph. What you guys can see here is that indeed, the around about 475 basis points for the Fed funds rate is what the market is pricing in for. And keep in mind, the Fed funds rate today, the effective is about 533. But what you can see is that the left tail risk all the way down here, and this is updated, this is from a couple of days ago, there's very little pricing in or probability, very low probability of a deep recession. Why do I say deep recession? Because if there's a deep recession or a strong recession or a hard landing, that would imply that the Fed would have to cut aggressively and cut by more, and therefore where the interest rates would be much more like at 200 or 300 or 250 or even all the way down here. So if we actually look at that, another way of looking at that is here. You can see that a deep recession 0 to 200, there's only a 4% probability. And in fact, in the last week, and again, this was updated a couple of days ago, that's gone down. But what's interesting is that you can see that the right tail risk is actually getting more and more elevated. And what do we mean by right tail risk? That means the possibility that the Fed will cut less. And so the Fed funds futures rate in December of 2024 will actually be higher than where it is, not higher, but will come down less. Is actually, you can see it's quite significant. So you see here the skew is much more towards the right. And you can see that just in the last week, the higher for longer, basically saying that the Fed funds rate at the end of December 24 will be greater than 500 basis points, has actually gone up 7% in the last week. So it's saying that the market has shifted the risk, the tail risk, to the right. But if we actually see what's priced in, is a sticky landing, about 49% is saying that it's going to be somewhere between 400 and 500 basis points by the end. But all I'm trying to say, guys, there's two takeaways for me from this, is that A, the market, as I say, if you just look at the single number, let's say on the Bloomberg, people say what's priced in, it essentially sort of just takes a median of all of this. But don't forget that if you look a little bit under the hood and a little bit more detail, almost nobody, 4, 5, 6, 7% is pricing in aggressive cuts. Now, from a purely probabilistic trading percentage, one could say that, deep out of the money calls on, let's say, SOFR December 24, or let's say the ZT or something, it's a bit of a lottery ticket, but technically that's going to be very cheap because no one's really expecting that. The market is not at all positioned that way. On the other hand, the other thing which I'd like to sort of just bring to your attention. Sorry, I just got a message. The other thing I'd just like to bring to your attention is that the market is actually relatively hawkishly positioned. And even though the average might be here somewhere, there are plenty of people who actually believe that the Fed will be less dovish or will cut less. And so therefore, I'm trying to sort of understand the market reaction on Wednesday. If they do take out, let's say, just sort of one cut, maybe the market reaction will not be that violent. It may actually require a little bit more. Now, why do I say that? Just because let's start looking at a few little charts here. And which is what I'm going to do. So let's just look, okay, go back to a couple of dailies. So if we look at something like just look at a few things here, we can see that, for example, the ZT, this is the daily chart on the 2 years futures. You can see over the last 5, it was just sold off, sold off, sold off, sold off. So a lot is being priced in already, is my point, okay? If we look at something like the TUA, which is the sort of proxy for the ZT, is the ETF, same kind of thing. That's come down, aggressively. It's been priced aggressively over the last 5 or 6 days. If we look at the, let's say we can even look over at the German bonds. Let's look at, let's say, something like the Schatz, the Bobble, which is the 5-year, that's come down a lot. We can see even in the equities, it hasn't come down a huge amount, but we had a little bit of selling off. You can see that in the yield curves, you can see gold's come off a little bit, not that much, which is quite interesting. Gold has been, I would say, surprisingly resilient. But if you look at some of the yield curves here, you can see, let's say, like the twos tens, which no, it's the fives tens, the twos tens has come just off a little bit, but not too much. Actually, if anything, it's steepened a little bit. And the same here, you can see the fives thirties. That's the one where the pain has been taken, and not so much the twos, but the fives. So there's been quite a lot of sort of a flattening in the curve. Okay, so that leads us to how to trade that. So I'm going to look at a few other things as well. I think it's pretty simple here, guys. Looking at that earlier table, that's the way you've got to look at that. See what Powell has to say as well. But before I leave this video, I just want to look at a couple of other things here, guys, and look at where some of the levels could be. The issue what I was going to say, and again, want to look at something like the 2-year. What's kind of interesting here is that if you look in the last week or so, we've basically come up, I mean, how many basis points? We've come up, what's that, about 30, 35 basis points in the last 5 or 6 trading days. So it's not as though the market has been inactive. We're also back at a point where the Fed was, as I mentioned earlier, back here. So the question is here is like, well, how much more can this go up? Now, what's interesting is that the SOFR contract since January the 12th has actually moved up 100 basis points, whereas this 2-year has moved about 61 basis points. And that's logical because the logic of the market is that, yes, the 2-year, if the Fed is hawkish, will need to go up a few basis points, but not as much as, let's say, what's happening in the next 6 or 9 months. So it's more logical that the September 24 and December 24 contracts will move more hawkishly than, let's say, the 2-year or the 3-year or the 4-year. So another way of looking at this as well, which is kind of interesting, is that if you want to be hawkish, there's trades, for example, like shorting maybe September 24 SOFR and going long, let's say, the 5-year bond. The idea being that the Fed at some point will probably cut. I don't know if that's getting too complicated, but it's kind of interesting to see that we know that the front end is still maybe about 25 basis points a little bit too rich. We saw that with the SOFR tool. But the question really here is that, can the 2-year go up more than, let's say, up to 4.85, which is around about here, to 8.7. So I'm thinking about 4.85 to 4.87 around about here. Sure can go up, but my point is that we'll see what happens over the next few days. But at this point, you're talking maybe more like 10 or 12 basis points. And I would actually say that something around about these levels, in fact, could actually be a buy for the 2-year. Because the point is that, it's going to be very doubtful to me, especially with the move index low where it is. I mean, are we really saying that the 5-year can go all the way back up here? That would be very unusual. That would have to be a scenario where the data did not cooperate at all over the next, let's say, 12 months, where, for example, the Fed took out not only one cut, but maybe didn't cut at all in 2024, and even indicated that they may not cut much more than 1 or 2 in 2025. This would require, for the 2-year yield to go all the way up here, would require a significant, but not impossible, but an extremely significant kind of repricing in terms of hawkishness. So that's kind of interesting. On the other hand, let's say, for example, we don't get any changes to the dot plot. I think there's going to be a relief rally. There'll be a relief rally in the bonds. There's going to be a relief rally in the stocks. So let's say on the 2-year, you've got to say, well, where could it go? Is it going to collapse? Probably not either, because at the end of the day, we could maybe go down, let's say, to 4.6, maybe down here, something like that. I think that would be reasonable. But then the question is, can the 2-year yield go down further down here? Probably not, just because I think to go lower than, let's say, about 4.6 down here would require, I mean, how many basis points is that? Let's go about 4.6. That's about 12 or 13. To go all the way down here, I think that would require significantly more dovish data. We would have to see the unemployment rate going up more, non-farm payrolls numbers coming down, and of course, we would need to see significant progress on the inflation numbers. So that's something to be looking out for. The other things as well, which is interesting, similar kind of situation. Just have a quick look over in Germany. Again, I think we could see the German yields go up a little bit more, up to, maybe 2.9, something like that. But again, I think in Germany, if we see, let's say, something like the Schatz go up to, 303.06 up here or something, that could even be a buy. Similar kind of situation on the bobble. Let's say, for example, it went up to 2.62 up to this level here. That could be an interesting buy for the 5-year. Similar kind of situation even on the 10-year. Of course, we know that the ECB was having a lot of speakers. They're talking about cutting interest rates, maybe in June. They seem to be a little more dovish. Also for political reasons than the Fed. And again, I think, let's say something like the 10-year went up to, 2.57, 2. Something around about up here. That could be interesting to buy, let's say, call spreads on something like the Bund, the 10-year. Another thing, guys, which I just want to have a quick look at here is over in Japan, looking at a few other things here, is if we look at here, a lot of people, we obviously have the BOJ on Tuesday about, I think about 3 a.m. or so. A lot of people, I mean, what's priced in? We can go and look. I was just looking at the terminal there just to see. I think it's here. Let's have a look. I think I've got it here. Yeah, this is Japan. So what you can see here, guys, what's priced in for this upcoming meeting in Japan is about 5 basis points. And as you guys know, a lot of people are saying they're going to sort of raise interest rate by a big 10 basis points. This gets very exciting. But the point is, a lot of that move has happened. And if we just go back to the 2-year yield, which I'll go to here on the chart, you can see that the 2-year yield basically since beginning of January has gone up from, let's say, 0 all the way up to about 18 basis points. And in fact, is now starting to come off. I do believe that a lot of the BOJ, I don't know, hawkishness or, has been front run at this point, has been priced in. Even if they were to hike by 10 basis points, I can't see this going up too much. And you say, yeah, but they will keep on hiking. You say, well, okay, but it's just interesting because if you look, there's the 2-year coming off. But if we have just a very quick look here, look at the Japanese 5-year, you can see that that's not really going up nearly as much. And if we just take that out quickly, I'll just put that onto the 10-year. You can see that actually, it's not coming up that much either. The 2-year's gone up here, the 5's kind of here, and the 10-year's there. So, maybe a little bit, it could cause a little bit of volatility, but I think in terms of the, the yen, we still have to, it's still a while before we get too excited about that. One thing I will just draw your attention to, I think I've got the chart here, is a potential FX play. So if you look here, if we consider that maybe the ECB at some point will be cutting, and the Japanese, the Bank of Japan may be hiking a little bit and maybe not cutting at the moment. What I think is kind of interesting is that this is the differential here between the 10-year yield minus the Japanese yield, and that's starting to head upwards in favor of actually the European currency. But I do believe if that gets up towards this level here, which is kind of actually, I might just put that on. Let's see if I can put a little box on that one, put a little nick box, as I like to call it. If we get up towards, I'm going to say 1.8, I'll put that level up there. That looks to be like a nice level. That, to me, would be a very interesting level if the differential got up there to be maybe saying that's kind of the max. And at that point, in terms of FX, you might start to be able to sort of think about, something like Euro JPY, which would be something like, up around about this level up here, or even preferably up around about this level here, something like, 160. I mean, you could start building a position here, 164, but certainly above this level here, 164.5, I think would be extremely attractive. And if that were to coincide with the differentials going up to about 1.8% between the German 10-year yield and the Japanese 10-year yield, I think that could be a really attractive entry point there. Just in terms of a couple of other things, guys, oil to me looks as though it could break out a little bit more. Let me just find the chart here. We have a few call spreads, but let's say I think oil's looking like it wants to break out a little bit. I mean, to me, it looks as though for sure that, just from a technical perspective, it could test up towards about, the $84 mark, something around about here, 84, 84.50. That would probably be the max just at the moment, because there are, there are some issues for the bear case, but I think oil could sort of push up a little bit more. Again, we'll have to see what the Fed does on Wednesday. I also just want to have a look at gold. Interesting, gold in my book has held up relatively well, considering the pressure that yields have been going up. I mean, it has come off a little bit, but it still hasn't tested this 2150 level. Keep an eye on gold. I mean, after the FOMC, if gold, let's say for example, they do change the dot the dot plot in a hawkish way, and gold does not absolutely collapse, I think that's actually quite a bullish signal. We know that central banks like the People's Bank of China is buying a lot, but in theory, gold should also come down on a hawkish Fed. What would be interesting buying level, I think, would be something like around about the 2080 would be a beautiful level to open up some long call spreads or something like that. But we'll have to see again on the Fed. Now, just in terms of the equities. Equities, as we know, have been strong. Let's look at the SPX, just like the cash index here. Now, on a hawkish Fed, I mean, we've seen this coming off a little bit, but it's been like a crazy bull run for, I don't know, what's this now, 3 or 4 months or so. So I think the point is, it's not really doing that much wrong. It's not as though it's sort of collapsing. So it's tricky to short actively at this point. But maybe, for example, if like there's a bit of a gap, you see this gap here, if we get a hawkish Fed, especially if they take out 2 cuts, that would be pretty hawkish. We can certainly test down to, maybe this level here and then something more hawkish down. You see this gap here on the SPX down there. But I think, anything down here, if it's not more than 1 cut taken out, quite possibly would be, kind of a nice buy. Similar kind of situation on the NDX. I might talk about that later in more of a video because we're getting a bit overdone here. So that's it, guys. I hope that was useful. That's the thinking. Look at this scenario analysis. It's all about those dots. Of course, technically Powell. I mean, what could be tricky and complex is whether the dots were saying one thing, maybe was unchanged, but maybe Powell verbally was very sort of hawkish, or vice versa. Maybe the dots, maybe they take out a cut and then Powell says, oh, we're getting close and all that kind of stuff. And it's interesting because I was looking at a bunch of research over the last couple of days, and not everyone does believe that they're going to change the dot plot. For example, I was looking at Danske Bank, their research, and ING. And both ING, for example, believe they actually will cut, not in June, but in May. So there are some people out there who are saying that, they do believe the data will start to significantly weaken over the next few months, and the Fed will want to get a couple of cuts in before the US election. So we also have to understand that there's also a reasonable chance that the Fed does not change the dot plot. And in that case, I think we will get definitely will get a relief rally. So it's going to be a tricky one because they may do nothing. They may be a bit hawkish. They may be a bit more dovish than the market expects. So there's going to be a fairly wide range of non-predictable binary outcomes. So probably the best thing to do is just to, as I say, look at your different scenarios. Maybe wait until the press conference is completed, and then pick your poison and go for it. Anyway, I hope that's useful, and we shall keep on talking. Thank you.